JPMorgan didn't just mention Hedera, they signaled that the public permissioned model is the only gateway wide enough for institutional trillions to finally move on-chain. The world's largest bank just hand-picked one network to define the future of money, and yet, the broader market is always looking the other way. So when JPMorgan Chase Asset Management, a firm overseeing $4 trillion, releases a report on the future of liquidity, they don't use examples lightly. Now, in their latest analysis of money market funds, they specifically identified Hedera Hashgraph as the primary example of a public permissioned ledger. This is not just a footnote, it is a validation of the technical architecture that the banking world has spent years trying to find. They are looking for a system that provides the transparency of a public network with the strict regulatory controls of a private one. JPMorgan's global liquidity business manages $1.4 trillion, with $1.1 trillion in money market funds, MMFs. This massive pool represents the immediate target for tokenization, yet the current on-chain footprint of these funds is less than 0.1% of their total global value. While most of the crypto industry is obsessed with total decentralization, the biggest players in finance have different priorities: security, predictability, and compliance. JPMorgan's report highlights that the current money market industry is 99.9% untapped by distributed ledger technology. Now, by singling out Hedera, they are effectively telling the rest of the market which set of rails they believe can actually handle the weight of global finance without breaking. This type of network offers similar potential as permissioned networks to scale, but with added security and regulatory controls. Hedera Hashgraph is an example of this type of work. This distinction matters because it separates Hedera from the move fast and break things ethos of decentralized finance. JPMorgan isn't looking for a playground. They are looking for a fortress. Unlike private ledgers like JPMorgan's own Connexes or Finality, which are closed loops, Hedera is classified as a public permissioned, which this allows it to bridge the gap between the internal bank silos and the open global liquidity of the public internet. By positioning Hedera as the blueprint, JPMorgan is acknowledging that the future won't be built on purely private or purely public chains, but on the hybrid model that Hedera has pioneered since its inception. Most people think that crypto is either private or public, but JPMorgan says that the real money lives in the middle. Now, the traditional financial world has long been trapped in a trilemma. They want the massive liquidity of a public network, the high speed of a private one, and the strict regulatory compliance that only a controlled environment can provide. For years, banks tried to build their own private walled gardens, but those ledgers eventually became siloed and lacked the global reach needed for multi-trillion-dollar markets. The public permissioned model, though, represents a paradigm shift in how institutional value moves. Now, in this structure, the network is open for anyone to use and build on, but the actual consensus, the process of validating transactions, is handled by a select group of vetted, reputable entities. Now, this creates a trust layer that is missing in purely anonymous networks. Here you can see a comparison matrix that shows private ledgers, the high privacy, low liquidity, the public permission list, which is low privacy, high liquidity, and public permissioned, high privacy and high liquidity. Now, the visual highlights how Hedera occupies the unique center point where institutional requirement meets global access. By keeping the consensus layer permissioned, the network avoids the congestion and unpredictable fee spikes common on networks like Ethereum. It also ensures that the entities running the infrastructure are known, legal entities rather than just anonymous mining pools. Now, this is precisely why JPMorgan's report highlights Hedera. It provides the the added security and regulatory controls that are non-negotiable for a firm managing trillions of dollars in assets. Public permissioned, right? Anyone is allowed to make transactions on the network. The nodes which constitute the network and facilitate those transactions must be invited to join. This model, it allows for a level of oversight that satisfies global regulators without sacrificing the benefits of a distributed system. It means that while the ledger is public and transparent, the governance is professional and predictable. Here is a flowchart, right? The consensus gatekeeper, if you will, that shows the Hedera Governing Council, and it comprises of firms like Google and IBM, reviewing and approving node operations. Now, this visual, it demonstrates the shift from proof of work to proof of reputation, where the cost of bad behavior is the destruction of the multi-billion-dollar corporate brand. Ultimately, JPMorgan is signaling that they aren't interested in the wild west of decentralized finance. They are looking for a system where the rules are clear, the actors are identified, and the technology is built to handle the heavy lifting of the global economy. We are currently at less than 0.01% of what is coming. The gap between where we are and where we are going is where the generational wealth is created. While retail investors fight over small cap fluctuations, JPMorgan is eyeing a market so large that it practically defies comprehension. They have identified that while money market funds are a $10 trillion industry, the portion currently living on a blockchain is almost non-existent. Now, in their strategic white paper, JPMorgan highlights that the current on-chain footprint of money market funds is roughly 99.9% untapped. Now, to put that into perspective, the total value of tokenized real-world assets today is just a tiny fraction of that global liquidity pool. The transition from legacy systems to digital rails is not a maybe. It is a mathematical necessity for banks looking to reclaim billions in trapped capital. Here we have a bar chart that compares the $10 billion, current tokenized MMFs, to the $10 trillion total global MMF market. Now, the visual basically uses a microscope slither to kind of represent the current state, emphasizing the massive 1000x growth potential remaining to reach full saturation. By identifying Hedera as the blueprint for this transition, JPMorgan is essentially providing a map for the new financial world. This isn't about disrupting the banks. It is about the banks upgrading their own internal plumbing. Do you believe institutional adoption will happen faster in the US, given the scale of Wall Street, or in the United Kingdom, where the regulatory environment is moving at lightning speed? You can let me know your thoughts in the comments below. Adoption of tokenized money market funds is accelerating worldwide as regulatory frameworks mature. Tokenized solutions are poised to play a central role in modern liquidity management. This acceleration is driven by efficiency. On traditional rails, a money market fund settlement can take hours or even days. On Hedera's ledger, the same settlement can happen in seconds at a fraction of the cost. Here you can see a growth projection line, which shows the rise of RWAs, or real-world assets, from 2024 to 2030, with a steep incline beginning in 2026. Data highlights a 75% compound annual growth rate, aiming for a $16 trillion valuation by the end of the decade. When a firm like JPMorgan talks about a 99.9% untapped market, they aren't just making an observation, they are placing a bet. And for the first time, they've named the technology that they expect to win. While retail traders were distracted, Lloyds and Abrdn just settled the FX market on Hedera rails, proving that the theory of institutional adoption is now a reality. Now, this wasn't a laboratory experiment or a closed-loop simulation. It was a landmark transaction in the United Kingdom, involving two of the nation's largest financial powerhouses and the FCA-regulated exchange Archax. Now, the significance of this pilot cannot be overstated. The United Kingdom represents the global epicenter of foreign exchange, processing more value than almost any other jurisdiction on Earth. By using Hedera to settle trades, these institutions are tackling the massive friction inherent in the traditional collateral management. The global foreign exchange market is a behemoth, but the UK alone processes approximately $5.4 trillion in daily volume. Now, this visual, it compares that staggering daily flow against the total market cap of the entire crypto industry, illustrating why institutions are laser-focused on optimizing these specific rails. In this pilot, tokenized units of an Aberdeen money market fund and the UK guilds were used as collateral for FX trades. Now, normally moving these assets takes days and requires complex manual reconciliation. On Hedera, though, these assets were moved and settled in seconds. Now, this efficiency allows the banks to free up capital that would otherwise be trapped in the settlement pipeline, directly impacting their bottom line. This wasn't a proof of concept. They wanted to test it in a real-world application. They can suddenly move value around 24/7 instantaneously. There's no need to use traditional rails. This shift from a T+2 settlement to a T-instant settlement is the hidden truth that JPMorgan was hinting at. The plumbing of the global economy is being replaced, and it's happening on a network that can handle the sheer velocity of the FX market. Here you can see a side-by-side comparison of the legacy settlement versus the Hedera settlement. The visual highlights the 2.9-second finality and fixed fees of Hedera against the 48-hour delay and variable intermediary costs of traditional banking systems, showing a 95% reduction in operational friction. By demonstrating that regulated digital assets can serve as collateral under existing legal frameworks, Lloyds and Abrdn have cleared the path for every other major bank to follow. Betting on institutional tech requires an institutional mindset, and that starts with protecting your own capital. Now, as we watch JPMorgan and the UK's banking giants align themselves with the Hedera network, it is easy to get swept up in the excitement of mass adoption. However, before we go any further, we do need to address the reality of the market. Now, I am not a financial advisor, and this is not financial advice. The crypto market is volatile and inherently risky. You should never invest money that you cannot afford to lose. My goal is to provide the investigative research, but the responsibility for your portfolio starts and ends with you. Now, building on that institutional fortress means adapting and adopting a professional approach to safety. Now, one of the biggest mistakes that retail investors make is relying on a single point of failure. If you are keeping all of your assets on one exchange, then you are vulnerable to service outages, regulatory freezes, or maybe even unexpected insolvency. Here you can see a redundancy map that shows a central portfolio connected to 4 distinct KYC-verified exchanges. The visual illustrates the concept of exchange redundancy, where liquidity is distributed to ensure that even if one platform halts withdrawals, your access to the market remains intact. To manage this risk, I use a redundancy strategy. I maintain multiple KYC'd accounts across several top-tier exchanges. If one exchange fails or goes offline during a period of high volatility, then I have 3 others ready to go. Now, you can find my preferred vetted exchange listed on my website, and there is a link for that in the description down below. If you want to dive even deeper into professional grade risk management, portfolio construction, and advanced technical analysis like Elliott Wave or Smart Money Concepts, then you can check out the link in the description for the Cheeky School, because using the code provided will also give you 50% off of any of the paid courses, helping you transition from this reactive trader to a strategic investor. In a world of digital assets, your first priority isn't the return on your capital. It is the return of your capital. Security is the foundation of every successful long-term strategy. Beyond individual security, the fortress also includes staying ahead of the data. Now, our free Discord is available via the link that is in the description below, and it is where we have community discussions. But If you want the real-time edge, our paid memberships provide whale alerts, institutional buy and sell signals, and technical analysis that you won't find on the public feed. Here you can see a risk mitigation checklist. It displays 5 key pillars. First, you have the exchange redundancies. Second, cold storage utilization. 3 is your portfolio diversification. 4 being continuous education, and 5 real-time data access. Now this serves as a visual guide for the viewer to assess their own operational security. Once your foundation is secure, we can look at why the structure of Hedera itself, its very governance, is the final piece of the puzzle that JPMorgan finds so attractive. You can't run a global economy on a network controlled by anonymous miners. You need the Fortune 500 at the table. While traditional crypto enthusiasts praise the decentralization of faceless validator pools, JPMorgan and the world's largest asset managers see that as a liability. Now, in their world, accountability isn't just an option, it is a requirement. This is where the Hedera's governing council becomes its most powerful competitive advantage, creating a moat that other protocols simply cannot bridge. Now, the council isn't just a list of names, it is a global consortium of heavyweights like Google, IBM, Deutsche Telekom, and Dell. Now, these organizations, they don't just oversee the network. They own and operate the initial nodes, making decisions on software upgrades, treasury management, and legal compliance. For the institutions like JPMorgan, this provides a level of professional predictability that is non-existent in pure decentralized models. Here you can see a global map, the council moat, if you will, that highlights the diverse geographic and industrial footprint of the Hedera Governing Council. It categorizes members by sector, technology, finance, telecommunications, and education, demonstrating that no single industry or nation can actually exert undue influence over the network. By distributing power among the world's most reputable brands, Hedera solves the problem of collusion that haunts other networks. Now, these companies have multi-billion-dollar reputations to protect. The cost of acting maliciously against the network far outweighs any short-term gain. This is the proof of reputation that institutional investors crave. The Hedera Governing Council is designed to be the most decentralized governance model for a public ledger, ensuring that no single member or small group has control. This governance structure also ensures that the network evolves in a way that is bank-friendly. While other chains might face chaotic hard forks or governance deadlocks, Hedera moves with the clinical efficiency of a corporate board. Here we have a diagram that shows the term limits and rotation schedule for council members. It illustrates how members are elected for 3-year terms, ensuring a constant influx of new perspectives while preventing any single entity from becoming a permanent fixture of power. JPMorgan values this model because it mirrors the stability of the traditional financial systems that they already trust. They aren't looking to burn the system down. They are just looking for a system that is built to last for decades, not just until the next hype cycle. The warning from JPMorgan is actually a message to every other network. Follow the rules or be left behind. And while many in the crypto space view regulation as a threat, the world's largest financial institutions view it as a prerequisite. Now, for a network to host trillions in assets, it must exist within a legal framework that regulators can understand and approve. Now, this is why the JPMorgan report doesn't just mention Hedera's tech, it emphasizes the regulatory controls built into its very foundation. Hedera has positioned itself as the green and compliant choice for the future of finance. In an era where ESG, that's your environmental, social, and governance scores, indicate where institutional money flows, being carbon negative isn't a PR stunt. It is a core requirement for any bank operating in the United Kingdom or Europe. Here you can see a comparison chart which shows the energy consumption per transaction for Bitcoin, Ethereum 2.0, and Hedera. The visual highlights Hedera's carbon negative footprint, and it uses use of environmental offsets, proving that it meets the strict net zero mandates required by modern global banks. The UK's Financial Conduct Authority is currently leading the world in creating a sandbox for digital securities. Because Hedera's native features, like the Hedera token service and consensus service, allows for built-in compliance at the protocol level, it fits the regulated fintech mold perfectly. Now, here's a question for you. Would you prefer a project that is purely decentralized and resists all oversight, or one that is bank-ready and designed to capture the world's largest capital markets? You can let me know your thoughts in the comments down below. Digital currency regulation is not a hurdle to be cleared. It is the infrastructure upon which the next generation of global liquidity will be built. Institutions require certainty above all else. This certainty is what separates a speculative asset from a foundational layer of the global economy. JPMorgan's signal isn't about the price of a coin, it is about the prominence of the ledger. Here you can see a timeline that maps out the FCA's regulatory milestones from 2024 to 2026. The visual showcases the transition from the digital securities sandbox to the full integration of tokenized money market funds into the UK's primary markets, highlighting the favorable environment for Hedera-based pilots. As the regulatory walls close in on less transparent networks, Hedera's early commitment to compliance is proving to be its greatest strength. It is not just surviving the new rules, it was actually built to thrive because of them. The signals are no longer just whispers, they are a deafening roar originating from the very heart of the global financial system. We've analysed the JPMorgan report, the multi-trillion-dollar UK pilots with Lloyds and Abrdn, and the structural moat provided by the governing council. This isn't just about HBAR as a token, it's about Hedera as the operating system for the next century of money. We are witnessing the evolution of a network from a speculative experiment into an essential piece of global infrastructure. The Hedera roadmap summary focuses on massive scale liquidity, showing the transition from 2024 pilots to 2026 full-scale production. Key milestones highlight the integration of the Hedera token service, HTS, across major European and US banking gateways, targeting the $16 trillion RWA market. As these trillions of dollars in money market funds move onto the ledger, the demand for the network resources will scale proportionately. Every transaction, every tokenization event, and every settlement requires HBAR to power the consensus. This creates a feedback loop of utility that most retail investors haven't even begun to model. Now, to stay ahead of these institutional movements and get real-time alerts on where the smart money is flowing, make sure that you do join our free Discord through the link that is in the description. The shift to digital ledger technology is inevitable. The only remaining question for institutions is which network provides the stability and regulatory peace of mind to host their most critical assets. The hidden truth is that the choice has already been made by the players who actually move the markets. Now, JPMorgan, they didn't need to name Hedera, but they did. They provided the blueprint for a 99.9% untapped market and placed Hedera at the center of the architecture. Now, the warning isn't for those who hold HBAR, it's for those who are waiting for an even clearer signal. By the time that the masses recognize the shift, the window of the liquidity gap will have closed. The HBAR utility cycle demonstrates how institutional volume leads to increased transaction fees, which directly feeds back into the network security and governance sustainability. As real-world assets like MMFs and FX settlements scale, the network transitions from speculative valuation to a model driven by pure technical utility. The evidence is clear. The plumbing of the world is being replaced, and the new pipes are being laid by the world's most powerful banks. This journey isn't just the beginning, and the road ahead is paved with institutional capital. Now, to understand more about Hedera and the latest crypto news, you can click the video that is on the screen right now.